Hey everybody, my name is Good evening, 13th of December 2016. Video commentary for you. I'll try to keep it quick. The 1-year daily chart for the S&P in front of you. We're going to look at the technicals for a minute. Here's that trend line I've been drawing your attention to. It connects the February to the Brexit low, and then you can see that it was definitely an area of resistance for several weeks. Then it became a little bit of support, broke down through it, and I said in here that if we can break through that with some momentum, suddenly we're going to be looking at bigger and better things. That appears to be the case. How do you base momentum? Well, one of the things you do is you look at volume. This is the on-balance volume indicator. So basically, this upward move here just simply suggests that the up days are carrying more volume, more shares are trading hands than there have been on the down days from this pre-election low. And there was a sideways move here, and this is a pretty robust look, but the trend is definitely in the right direction. This suggests that, at least for now, that the rally is for real, and there's a fair amount of conviction underneath it. That would be a good sign for the bulls. The advanced decline line, the breadth indicator, that's a very positive sign. Substantially more stocks are rising than falling. That's a good look that the overall market move is fairly broadly based. The moving average convergence, divergence, if I had to pick my favorite technical indicator, this is probably it. It's the 12-day moving average minus the 26-day. That's what this line is here. So when it's sloping up, the momentum on the near term is strong. This is the 9-day moving average of that number. This is the signal line. When it moves above, short-term traders, I should say when the MACD line moves below it, short-term traders would tell you that's a bearish signal. You can see they probably began to get excited there, but then we took off in the other direction. So this is a very good looking trend. In the past, I used to draw for you, and I will again in the future, trend lines to show bearish divergences when this one was bearish or bullish and going against the grain. That's something to take seriously if you're a shorter term trader. But right now we just don't have any of those indicators. So the technical setup so far looks pretty good. On a shorter term basis, you look at the RSI, or the relative strength index. This is what's called the overbought area above 70. Short-term traders would be selling this market. On a near-term basis, swing traders would as well, expecting a short-term pullback to make money on. But it's been my observation that relative strength overboughtness doesn't get taken care of always by downdrafts. Sometimes it's just sideways movements for a while. It seems like, at least for now, and we'll see how long it lasts, it seems like every little dip tends to get bought. So again, that story may change. And I'll be here to tell you about each story as it unfolds in the weeks and months to come. This morning, Fed or ex-Fed president, Dallas Fed president Richard Fisher, was on CNBC. I didn't see it, but I caught this headline. Ronald Reagan gets elected. The market, the S&P 500 that is, was up 8.5% until he gets inaugurated. Next year it's down 20%. He cautioned viewers of this morning's show that the excitement surrounding Trump's election and pro-growth agenda could come with pitfalls. What he says it illustrates, at least to him, is that expectations are important, optimism runs strong, but then reality sets in terms of how long it takes to get things done. So I found that interesting. I do respect the gentleman. I've listened to him for years. I think he's a thoughtful, intelligent commentator on the world we live in and the economy and so forth. But let's take a look at what he was talking about. So here is the beginning of the Reagan regime. I imagine the election, that's about November 10th. That must have been when it happened. Here's a very nice move. He did say that it went up 8.5% between his election and inauguration. That's not where it peaked out. It actually peaked out right here, as you'll see in a second. But I've been talking a lot about the moving averages. So in this case, the setup looked okay, although the market did roll over, and there's a couple of lower highs from this trend right here. But certainly and you can see the moving average is beginning to respond to it. But this right here would not be a warning sign. The 50-day solidly above the 200, both of them still just kind of angling in a positive direction. You compare that to where we are today. The trend looks better. We keep seeming to accomplish higher highs. So that's definitely a better looking setup as of 12/13/2016 versus 12/13/1980. And then the moving averages are in the right places, and you can see they're sloping in a very positive way. If we take this one out, though, and cover the year he was talking about, 1981, we're beginning to see the setup really began to break apart right here. You can see the moving average. We had a correction the first part of 1981. came out of it. It's still a pretty positive look there. But then when this rolled over, the market rolled over. We had a really big dip in the fall, and sure enough, it was a pretty ugly year. And you can see the setup for the rest of the 80s was beginning to look better. And those of you who've been around a while like me know that the rest of the decade, actually, notwithstanding the 1987 one-day crash, was a pretty great time to be in the market. So what else would we look at? So this tells us, yeah, there's something there in terms of the moving averages and so forth. Let's go back to some of those other maybe nearer term technicals and see what they would have been telling us back in 1980. In fact, we'll just focus on that moving average convergence divergence indicator. And that actually was showing an exceedingly bearish sign. That's the beauty of this indicator, folks. Here, the market's looking okay. You look at the MACD, and suddenly you've got a real strong sell signal there. You've got it rolling over. You have a big bearish divergence. Everything seems to be breaking apart. So this was sending a very strong signal back there in the technicians that this is a look that we should be concerned about. Again, if we now begin to compare that to where we are today, well, that is just not the signal we're getting. This is a very good-looking setup going forward. So not that this can't change, and of course I'll be here to show it to you as it changes and set your or help you gauge your short-term or near-term expectations accordingly. But right now, I'll say it again, with the data we have at our disposal, the technical data, the fundamental data, and the economic data, the market is not sending us a signal that we should be at least thinking that this bull market is going to run out of steam anytime soon. I do expect the buyers to get worn out in the not too distant future, see some sideways action, definitely see some dips. We should get a 10% correction. It used to be something we get every year this next year. So certainly a great deal of volatility is very much within the realm of possibilities, but I'll say it again, the setup right now looks pretty good to me. One other thing in closing I want to show you is just another look, and there's so many things that we can compare in 1980 versus today, but let's just look at the interest rate scenario. The 10-year Treasury bond back then on 12/13 of 1980 was at 13.2%. Today it's at about 2.5%. So in terms of the stress or the pressure that higher interest rates might have on an economy after we went through what we went through in the late 70s and early 80s, very different setup today. I think Mr. Fisher did talk about the fact that stocks tend or that interest rates tend to be a headwind for the market when it's on the rise. So I think, and again, reading more of his commentary, he actually was trying to draw some conclusions to, let's just bring this forward, from even an interest rate trend standpoint to today, that interest rates were trending up back there in 1981 and the market was having a rough time. But my goodness, we have had a phenomenally long secular bull market in bond prices, which means yields have been coming down. The question is, should we just take for granted that stocks are going to go down during periods of rising interest rates? I would say absolutely not. It's all about looking at it within the context of the economy at the time. So here we have interest rates going up, and we have the market moving a little sideways and so forth. Yeah, it seems to be coming down, but you see interest rates rising there and the market continuing to rise all the way through it. Here we have a period in the late 90s of very much rising interest rates. We have the market rising right with it. We have a higher trend here. We have the market going up and so forth. So I just don't think it is safe to say that when interest rates are going up, we should always expect stocks to be tanking. I'll say it again, it's all within the context of the economy. When the economy is doing well and beginning to accelerate, we absolutely expect money to rotate out of bonds into the stock market. We also expect the Fed to be raising interest rates in that environment to keep, in their minds, from a repeat of the late 70s where we had a lot of inflation. So I think one thing is a given, and that is that interest rates are going to be trending higher going forward. It's going to be not good for those investors out there, not our clients, thankfully, who are in bonds going forward. There's going to be good days and bad days. But I believe this secular 35-year, roughly secular bond market is probably finally coming to a close, and we have something different to look forward to going forward. And again, in this environment with an improving economy and higher interest rates, I'm not going to worry yet about the stock market interest rate negative correlation. That will come later in the cycle. This will be a conversation we will have at some point. It's just not one we need to have today. Thank you, folks, as always, for watching and listening, and I will be back very soon. Take care.